This is part one of the Introduction to Financial Statements video series. There are 3 parts, and we'll start by discussing the possible forms of a business as well as the users of financial information. This video series covers the types or forms of a business, who looks at the financial statements of a business and why, and the financial statements. Then check out my other videos that illustrate the major categories or activities of a business, how the accounting equation is impacted by those activities, and finally what additional financial information is on the statements themselves. The key to understanding accounting is to really understand the terminology and how things work together. Accounting professors mostly talk about corporations, but all organizations, except for not-for-profit ones, have nearly identical financial statements. I certainly do not want to discount not-for-profits, but it is easier to learn for-profit accounting first and then learn how not-for-profit organizations differ. In the United States, most business enterprises are organized as sole proprietorships and partnerships, even though the news talks about corporations more than anything else. Some people add a 4th or 5th type of organization, but it depends on the state. So we'll talk about the 3 everyone agrees on, then we'll mention the others. We're going to start with sole proprietorship. An unincorporated business owned by one person is a sole proprietorship. Often the owner acts as the manager. This form of business organization is common for small retail stores, service businesses, and professional practices in law, medicine, and accounting. In fact, the sole proprietorship is the most common form of business organization in our economy. It is very easy to start your own business. You simply do it. There are no forms to complete, and you get to control your business without getting approval from others. And since you're running your own business, you've got tax advantages because you're being taxed at your own individual tax rate. While it's smart practice to keep the money from a sole proprietorship separate from your regular cash, because from an accounting viewpoint, a sole proprietorship is regarded as a business entity separate from the other financial activities of its owner. However, from a legal viewpoint, the business and its owner are now regarded as separate entities. Thus, the owner is personally liable for the debts of the business. If the business encounters financial difficulties, creditors can force the owner to sell his or her own personal assets to pay the business debts. So while an advantage of the sole proprietorship form of organization is its simplicity, the unlimited liability feature is a disadvantage to the owner. Partnerships. An unincorporated business owned by 2 or more persons voluntarily acting as partners or co-owners is called a partnership. Partnerships, like sole proprietorships, are widely used for small businesses. In addition, some large professional practices, including CPA firms and law firms, are organized as partnerships. They're easy to set up because you and at least one other person will agree to work together. You may have as many partners as you wish, and while you share control, you also share talents. Each person's share of the business goes back to the partner who's taxed at their own rate, which is an advantage. Now, as in the case of a sole proprietorship, the owners of a partnership are personally responsible for all the debts of the business. From an accounting standpoint, a partnership is viewed as a business entity separate from the personal affairs of its owners. Creditors of an unincorporated business often ask to see the personal financial statements of the business owners, as these owners ultimately are responsible for paying the debts of the business. And, like the sole proprietorship, a disadvantage is the personal liability of the partners, including the debts of their partners. Corporations. If a partnership and sole proprietorship are easy to establish, then one form must not be easy, and that's a corporation. A corporation is a type of business organization that's recognized under the law as an entity separate from its owners and incorporated by filing with the state. Ownership of a corporation is divided into transferable shares of capital stock, and the owners are so-called shareholders or stockholders. Stock certificates are issued by the corporation to each stockholder showing the number of shares that he or she owns. While it isn't easy to get started, It is easy to change owners, and the stockholders are generally free to sell some or all of these shares to other investors at any time. This transferability of ownership adds to the attractiveness of the corporate form of organization, because investors can more easily get their money out of the business. Corporations offer an even greater opportunity than partnerships to bring together large amounts of capital from multiple owners. There are many more sole proprietorships and partnerships than corporations, but most large businesses are organized as corporations. Thus, corporations are the dominant form of business organization in terms of dollar volume or business activity. And if the other forms of organizations have the owners personally liable for business debt, there needs to be an organization that doesn't do that. The owners of a corporation are not personally liable for the debts of the business. The owners can lose no more than the amounts they have invested in the business, a concept known as limited liability. This concept is one of the principal reasons that corporations are an attractive form of business organization to many investors. The main disadvantage is the government considers corporations to be a separate legal entity. If that entity is responsible for paying its liabilities, then that entity must be taxed as itself. So the income from a corporation is taxed. After it's taxed, a portion of the earnings can be given to the owners in a form of a dividend. And because the individual receiving the dividend is a separate legal entity from the corporation, the dividend is taxed as income to the recipient. So, because dividends are not an expense and they're given out after tax, they are taxed once at the corporate level and taxed a second time as a dividend received by the shareholder. There are some who count these next types as part of corporations or partnerships, and some who consider them separate entities. Everyone agrees the three I just mentioned are the three forms, so I tend to leave it there and make sure to mention the other types. The most common form of business structure for small businesses is a limited liability company, or an LLC, which is defined as a separate legal entity, and it may have an unlimited amount of owners. They're typically taxed as sole proprietorships and require insurance in case of a lawsuit. This form of business is a hybrid of other forms because it has some characteristics of a corporation as well as partnership, so its structure is more flexible. Common examples of limited liability companies include startups and other small businesses. Family-owned businesses and companies with small number of members may operate as an LLC because it is a flexible business model that allows members to be active or passive in their roles. Some advantages of being an LLC is the limited liability. As the name states, owners and managers have limited personal liability for their business debts, whereas individuals assume full responsibility in a sole proprietorship or partnership. There's flexible management. LLCs lack a formal business structure, meaning their owners are free to make choices regarding the operation of their business. And there's tax advantages. Although it is a corporation, owners of LLCs may take advantage of what's called pass-through taxation. That allows them to avoid the double taxation that's done with dividends, and they're taxed at their own individual rate. Of course, there are disadvantages, and some of them include associated costs. The startup costs associated with an LLC are more expensive than setting up a sole proprietorship or partnership, and there are annual fees that are involved as well. Then there's taxes. In regard to unemployment compensation, Medicare, and other similar taxes, owners may have to pay it themselves. And in some cases, they may end up paying a higher tax rate than if they were a corporation. A cooperative or co-op is a private business, and it's an organization or farm that a group of individuals owns and runs to meet a common goal. These owners work together to operate the business, and they share the profits and other benefits. Most of the time, the members or part owners of the cooperative also work for the business and use its services. Advantages of a cooperative include greater funding options. They have access to government-sponsored grant programs like the USDA Rural Development Program, and they can depend on the type of cooperative. There's a democratic structure. Members of a cooperative follow the one member, one vote philosophy, meaning that everyone has a say regardless of their investment in the co-op. And they're less disruptive. Cooperatives allow members to join and leave the business without disrupting its structure or dissolving it. Disadvantages include raising capital. The larger investors may choose to invest in other business structures that allow them to earn a larger share, as the cooperative structure treats all investors the same, both large and small. And there's lack of accountability. Cooperatives are more relaxed in terms of structure, so members who don't fully participate or contribute to the business leave others at a disadvantage, and they risk turning other members away. That's it for our discussion over forms of a business organization. We'll move on to discuss users. Users of accounting information are both internal and external to the organization. Internal users are the primary users of accounting. There are three main types of internal users and their information needs. Owners need to assess how well their business is performing. Financial statements provide information to owners about the profitability of the overall business, as well as individual products or geographic segments. Owners are also interested in knowing how risky their business is. Accounting information helps owners in assessing the level of stability in a business over the years and to what extent changes in economic factors affect the bottom line of the business. Such information helps owners to decide if they should invest in any further in the business or if they should use their financial resources elsewhere in more promising business ventures. Managers need accounting information to plan, monitor, and make business decisions. They also need to allocate the financial, human, and capital resources towards the competing needs of the business, and they do this through budgeting. Preparing and monitoring budgets effectively requires reliable accounting data relating to the various activities, processes, products, services, segments, and departments of the business. Management requires accounting information to monitor the performance of a business by comparison against past performance, competitor analysis, key performance indicators, and industry benchmarks. Managers rely on accounting data to form their business decisions such as investment, financing, and pricing decisions. In case of the investment decision, for example, managers would require the return on investment calculation of a proposed project supported by reliable estimates of the cost and revenues. And there's also employees. Employees are interested in knowing how well a company is performing, as it could have implications for their job security and income. In recent years, the increase in the number of shares and share option schemes for employees, particularly in startups, has fostered a greater level of interest in accounting information by employees. External users are the secondary users of accounting information. I'll just mention some types of external users and their information needs. Investors need to know how well their investment is performing. They primarily rely on the financial statements published by companies to assess the profitability, valuation, and risk of their investment. Lenders use accounting information of borrowers to assess their creditworthiness, in other words, their ability to pay back a loan. And just like lenders, suppliers need accounting information to assess the creditworthiness of its customers before offering goods and services on credit. Customers need to know if they're going to be able to purchase a product as well as have the warranty honored. So they're too interested in financial information. And finally, tax agencies, they want their share of the revenue, so they need to know the accounting information. That's it for the first part of the video series on the introduction to financial statements. Check out the next video in the series. It's on the major activities within the business, and it's a guide to business operations and the statement of cash flows.